We have Andrew Chang. He is the technology director at S&P Global Ratings here. Andrew, you heard what some analysts are already saying in reaction to this report. We heard from company executives on the call last night. Want to get your read through.
Yeah, at S&P, we felt that this was a very strong second quarter. It met and exceeded our expectations, especially the data center compute revenue, which is essentially GPUs, up 162% year over year. So massive growth there. But I guess it fell a bit short on the third quarter guide. 32.5 billion is strong, but I think the street whisper numbers were more north of 33, perhaps even 34 billion. So a bit shy on that front. At the same time, what I was most focused on was the Blackwell progress. And that was the main concern going into earnings. And I think Jensen put that to rest. Blackwell is sampling now, started volume production, shipping in the fourth quarter. We'll have billions of revenues this fiscal year, all positive sign. Meanwhile, Hopper demand is still very strong. So the so-called delay in Blackwell, I think, sets up the company nicely, frankly, for calendar 25.
And Andrew, you have a AA negative credit rating on Nvidia. For those not familiar with the definitions of these credit ratings, what does that mean and why did you assign that one to Nvidia? Sure.
First of all, the credit rating is AA minus with a stable outlook. We upgraded the company back in April. And to put it plainly, Nvidia is the highest rated semiconductor company globally, along with TSMC in Taiwan and Samsung Electronics in Korea. So the highest rating from the semi perspective. We really like the tech lead that the company has and the strong product execution thus far. And we view Nvidia, unlike other semi companies, as a platform company, meaning it's not only a GPU company, but it has a full rack scale solution along with software, which no one has. And frankly, AMD's acquisition or announced acquisition last week speaks to this unique strategy that Nvidia has fostered and frankly has dominated over the past 5 years or so. So from a credit perspective, high profitability, high cash flow, really strong balance sheet.
We continue to hear from tech execs that there's a far greater risk of underinvesting in AI right now. But at what point, if we didn't see the return on these investments actually come to fruition, would it start to impact some of their credit ratings, knowing that there's so much money that would have been going towards these expenditures and out the door, essentially, to bring this to life?
Yeah, I think that's the main risk from the credit perspective, which is the potential for short-term swings in demand despite the long-term massive growth potential. So this is not going to be an up and to the right every quarter. Hyperscalers, as you mentioned, they can't spend fast enough. But if the ROI on their investments aren't up to par, you could easily see Amazon's and Microsoft's pausing purchases for multiple quarters. They've done that before with general servers, so they can clearly do that with AI servers. And when that day comes, numbers will be, I can't predict when. It's not for at least a couple of quarters, but over the next, let's say, calendar 25, I could see a scenario where the hyperscale spending declines meaningfully, and that could cause some panic among investors. But we have to remember that this is a long-term growth story, that we should not be so fixated on short-term swings.
Okay, so it's possible to see that deceleration of growth, at least from the hyperscaler spending on these products in 2025. I know you said it could come in the next few quarters there, but will there be signs that investors can look for that is approaching?
Yeah, the easiest sign you can look for is obviously all the commentaries from Amazon, Google, Microsoft, et cetera. And the commentaries have been nothing but strong. They're collectively, from a hyperscaler CapEx perspective, probably growing 50, 60% in calendar 24. We don't have a good read on what that will be in 25, but we're fairly certain that'll be growing next year. I would say growing 10%, 15% is a good likely scenario and probably priced into the market. If you start seeing commentaries regarding, hey, we're starting to slow down, or our CapEx spend next quarter will be flat versus the prior quarter, that should be sort of a signal to investors that, yes, Microsoft is now concerned about the return on investment on all these AI servers.
You mentioned at the top of our discussion here that Nvidia has one of, if not the strongest credit rating among some of the AI and tech companies on the street right now. Where are you hearing companies talk about AI though and saying, okay, they may be talking about it, but their credit rating doesn't suggest that they're actually in good standing enough to be able to pull off some of these massive investments?
Yeah, I would say the overall software sector, which I know has underperformed this year, are talking about AI, but we're not seeing tangible revenues yet, perhaps with the exception of, let's say, Microsoft or ServiceNow. But there are many companies out there, Adobe, Salesforce. These companies, again, software spending has been somewhat of a lagging behind a hardware spending. But our view is that the AI hardware spending will, over time, translate into better spending on the software side and and also on the IT services side. So ratings impact for software has been limited thus far, but I could see maybe 2 to 4 quarters from now where software spending does pick up on the AI side.
Andrew Chang, the technology director at S&P Global Ratings, thank you so much for your time today.
Great, thank you.